Welcome back to Fast Market. I'm Alex Coffey alongside Kevin Hinks. It's now time for our cash tag segment. Joining us from LikeFolio.com is a co-founder, Landon Swan. And in studio, we have TD Ameritrade Network contributor Jenny Horn. Jenny, we're talking Five Below, and I think that there's probably maybe some anxiety around this report given what just happened in some of these dollar stores post-earnings.
No kidding. The stock was at all-time highs actually earlier last week, I believe Monday, before then falling in sympathy with its dollar store peers after they issued very mixed earnings. And I would not say they were necessarily bad earnings, but guidance was definitely disappointing. And I think that is exactly the fear that Alex talks about. And this week, I'm sort of joking, these are the B-list retailers because it's a lot of these smaller names, but still nonetheless very important names to cover. And Five Below actually has a lot of things contributing to this report. They've been expanding at a very rapid rate with plans to actually open 180 stores by the end of the year, which would actually be an annual record for the company. Plus, they've actually opened this 10 Below retail section, which of course, then is things priced $10 and below instead of $5 and below, which has allowed it to increase its offerings, meaning now they're selling video games and home furnishing, which actually the CEO, Joel Anderson, said back in June has been a great way to overcome the pressures of inflation, which is sort of this big concern. But for this quarter, we're expecting revenue between about 640 and 660 million, which would translate to about a 50% year-over-year gain. And I feel sort of like I'm having deja vu because this is what Zoom was expected to post. And actually, they did post higher than that in terms of their sales growth year-over-year. But the stock now is seeing its second worst day ever. And I think that with so many of these earnings, it's all about guidance. So that is right now the huge concern with Five Below, because we saw both Dollar Tree and Dollar General issue actually weaker guidance, hiding some of these heightened freight costs and also inflationary pressures that they expect to weigh on their profits for the rest of the year. So that was sort of in the forefront of so many analysts' mind, and Dollar Tree actually saw a more sizable move to the downside following this report. So there is that concern now that Five Below could act similarly. Now, they have sold a little bit since, so there is that degree of, they have faced some selling already. But I do think that it would be, unusual that they would offer some completely different guidance than two other discount peers. And our first tweet today focuses on sort of comparing these names, which we often group together, which says, there just isn't any reason to go to a Dollar Tree now versus all the other stores plus Five Below. The brand is just rapidly becoming irrelevant and management is incompetent. So Alex and I were actually joking before we came on air about, we don't really see Five Belows in the city of Chicago. Now, I have seen them in the suburbs, but I did look. There is one in Chicago, so we had to fact check. But this is not a store you see nearly as much as a Dollar Tree, which has about, I believe, 16,000 stores nationwide, whereas Five Below actually only has about 1,000. So that is why its footprint feels so much smaller, which I think is something important to keep in mind. How we often compare these names, it is a much smaller company. But our next tweet just talks, a little bit more positively on Five Below, which says, Five Below is the old Five and Dime recreated. I like shopping in it some, great back-to-school store on a budget, and great store for kids to shop and not destroy parental budget. Want some cheap earbuds, sunglasses, beach toys, and candy. So, Landon, I think I am sort of not the target demographic here because I am not a kid and I do not have kids, but I know you have kids, and we have sort of talked about this discovery element before where you walk into a Five Below and you're not necessarily looking for one thing, you're sort of letting things find you. So I'm curious to see what your data has on Five Below.
Yeah, it's kind of a false equivalency when you compare these names, Dollar Tree, Dollar General. I think those two go together fairly well, but when you lump in Five Below, it kind of loses the narrative. It doesn't make as much sense because, there's no grocery and they focus on things like games and toys and electronics and collectibles and things like that. So it's not really essential items. It's more discretionary. And like you said, you go in there with some money and you're like, all right, let's find some stuff to buy. Maybe you're going with the goal of buying something specific like your last tweeter talked about. But more often than not, I think people are just going in there looking to spend some money, maybe pick up something cool and let the kids run around for a little bit. You're not going in there for groceries or essentials that your family's counting on you coming home with. And to that end, I think, you see a big difference in the happiness. And I think that's why, this chart is pretty relevant because you got Dollar Tree and Dollar General in the mid to low 60s when it comes to consumer happiness, and Five Below is up at 75. And if they're in the exact same space, this is huge. This is like clear industry winner or sector winner, but I don't think they're really in the same space. They are somewhat, they're discount retailers, but definitely a lot of people, including investors, see them in a sort of a similar light. And I think that's why, last week, those two, Dollar Tree, Dollar General, both got hurt on earnings, and they dragged Five Below down with them. That being said, they're looking at really tough comps. I mean, a year ago, they were just starting to reopen stores, Five Below, that is. They're just starting to reopen stores. People got stimulus checks, and that is the time to be, going and spending money at these stores. And so now we're a year later, and we're comparing to that point. So I think they have a very tough sales pitch ahead of this earnings call. We've got them, we do the earnings score -100 to +100. We've got them at a -46, so we're fairly bearish on Five Below. Now, I will say I liked being bearish way better last week at 237 than I do right now at 213. Dollar Tree, Dollar General both pulled this name down significantly, over 10%. So that makes things a little bit more difficult for a bear going into this call. But I can say that just mentions of the company are down. They've been fairly predictive of the stock price overall and just generally of revenue. And so the fact that they're pulling down right now, while they've got these, I think, nearly impossible comps coming in, leads me to believe that there's more likely to be a bearish reaction to this report than bullish. But again, I really hate the fact that they've already shaved so much off the top looking at their competitors.
All right, I got a problem. All right, and I understand, and again, much like Zoom video, I believe that the deceleration of growth is going to be a problem. But in terms of comparison, I think this is a tricky comparison. I don't compare a Kroger grocery store to a Toys R Us, right? Those are two different animals there. And I think these three comparisons that we have here Five Below doesn't really fall into that same category. Now, it could act exactly the same, and it did on Dollar Tree and Dollar General's earnings. But this is, number one, a wafer, small, thin company. I mean, 55 million, right around 56 million outstanding shares is really small. So this is a company growing unbelievably how much they're growing. So this could be a different scenario than, say, a Dollar Tree or Dollar General. Landon, are we comparing apples to apples here, or apples to something else here? Because, they don't sell the same things. Am I wrong there?
No, I mean, so they don't exactly sell the same things. And you talk about kind of what I said, but it's the same kind of mindset. Is you don't have a lot of money to spend and you want to spend some money. But you're not going there for essentials. You're not going there for household supplies or groceries, where you might go to Dollar Tree, Dollar General for those. But it still is the discount retailer, and I think Wall Street is just kind of straining to find someone to compare them to. And I think that's why this company has done so well, is that they're just kind of unusual. And, if you think, well, everything's under $5 except for, now the 10 below section, but everything's pretty cheap. Yeah. You think that you got to lump them in with these other companies, but you're right. That's really not the case. And it's more discretionary than anything, but they've done really well. I've been in some of these. They're fun to walk around in. And if you take in, the idea of spending $20, you're going to spend 50 because you're going to find 10 things instead of 4. They have neat things. It's clean stores. It's well presented. And it's, perceivably higher quality. I can't remember if everything broke that I bought or not, but I felt like it was going to last when I bought it. But you can see here, our mentions chart is just not great on this company. I mean, it has been fairly predictive, and there's a little bit of a lag there, a little bit of a lead, I guess you could say, and it's pulled back really, really low. And so I'm concerned with this report going forward. But again, man, I wish I would be talking, last Wednesday instead of today about going bearish on Five Below, because you can't just chop off that much of a percentage off the stock price and think the trade is exactly the same. So it was, I think, again, trading around a high of 237 last week. Now it's at 213. That changes the narrative of the trade, in my opinion. Going in blind without that information, I'm bearish. With that information, maybe I'm leaning bearish. Maybe I'm a little bit neutral.
Yeah, timing is everything, Landon. But I want to pick your brain here, kind of expanding on the comments you've made and what Kevin was saying. maybe the jury's still out on this, but how do we consider kind of trying to figure out why we would make an investment in this company, data aside? So you use the word discretionary. That to me seems like an investment you'd make in times of economic growth when times are good. But with the kind of low price that they have with their goods, you can also make that argument for it's a little bit more defensive performing. Maybe this is where I would shop if times weren't so good and I needed to get some toys for the kids or whatever it might be. And so, Landon, maybe that's kind of what you were alluding to, which is Wall Street doesn't know where this falls. But from watching this, as I know you guys have tracked this, does this still seem like to be a story about growth? And the more stores they're opening and the better the revenue numbers look, the better Wall Street responds in terms of stock price performance? Or is this simply going to be a defensive name the way that we see Walmart act sometimes, or Dollar General or Dollar Tree?
I don't think it's purely defensive. I think that they actually have positioned themselves where they can possibly do well in both environments. Now, who knows how long it's going to be until we see a defensive type of environment. But, one thing to consider, and I know you said don't look at the data, but it's right there in front of me, so I have to talk about it.
No,
One
definitely.
thing that we always see with LikeFolio is if a company's purchase intent is going up, the happiness always comes down. It's just sort of a function of the data. With more customers, it pulls that happiness down to the median level. This is one of the very few exceptions. When more customers are going to Five Below, their happiness holds or increases, which is incredible. So they have extremely high happiness customers who are telling their friends and family about it. They go in and the expectations are high, but they are met, which is something that we don't see very often. This is a special company in that regard. So long-term, LikeFolio data is bullish on this company. Short-term, I think they've maybe just extended a little bit too much. And I would expect a negative reaction. But again, it's tough with that haircut that they took last week.
Okay, so Landon, the optimist in me has a question about your happiness data because, okay, I agree with you and Kevin. I think that it's hard to make the comparison with these companies, especially considering they don't have this grocery unit, which I think then totally separates them from Dollar Tree and Dollar General. But 75% happiness, we've been doing this for a while now that I know that's high. I mean, that's one of the highest companies we really see across the board, correct?
Yes, it is. It's extremely high. And I think it's higher than iPhone, for example. I mean, people generally, when they get on social media, generally speaking, they're complaining. If you have a happy experience and an unhappy experience, the person that has the unhappy experience is way more likely to go and complain about it. So the fact that people are going on and talking positively about their experience really says that there's an incredibly high number of people who love this company. Yes.
So, Landon, as we wrap things up here and kind of put a long-term, short-term, clearly the sentiment leans bearish short-term, and we oftentimes talk about, where you're comfortable taking risk. I would assume here you're comfortable in that upside risk. You're just not sure how much of it's already been priced in. As for the long-term, given what you just said, it's higher potential happiness in the iPhone. It's clearly better than its peers, whether they're a good comparison or not. Are big sell-offs here potential buying opportunities for investors?
Yeah, I mean, if you want to get really greedy and try to play this perfectly, you play it to the downside on the report, and then you pick up shares and go long after that. I mean, that you try to swing for the fences and hit a home run. Of course, it can bite you if it goes the wrong way. But based on what I'm seeing, I'm expecting a slight pullback on earnings and then long after that for a longer-term play.
Good stuff. The co-founder of LikeFolio.com, Landon Swan. Thank you as always.